and welcome to Startup Street. I'm Ritu Singh, and with me is Shruti Mishra. Here are the key headlines from the startup space. Only a week after its largest layoff in years, Microsoft cuts more jobs. According to reports, more than 300 employees were told their positions had been eliminated.
Education financing startup Gyan bags 50 crore rupees in a Series A round from Class Plus and Pravega Ventures, physical presence and double the number of partnered financial institutions.
Homegrown sneaker brand Gully Labs gets 8.7 crore rupees in its seed round in a mix of equity and debt. The fresh capital will be used to diversify the product mix, expanding sales channels and open physical retail stores.
Madras High Court dismisses pleas by online gaming companies challenging Tamil Nadu government's rules imposing time usage restrictions on online real money gaming. Court says that online games or online entertainment is subject to regulation when it affects the public health of people at large. Adds the state cannot remain a mute spectator when the population at large is exposed to serious physical, mental and financial risks.
Elon Musk's artificial intelligence venture xAI is reportedly seeking $113 billion valuation in a new share sale. The firm is simultaneously raising $5 billion in debt. According to Bloomberg, Morgan Stanley has launched a sale of debt instruments for xAI. Well, those are the headlines we're tracking for you today on Startup Street. But our top story this evening, the Madras High Court has upheld Tamil Nadu's new regulations on real money gaming platforms, which impose time and usage restrictions. The court has dismissed petitions from major firms like Games 24/7, Jungly Games and Winzo, and it has ruled that the state's restrictions aim to protect users' mental and physical well-being. Ashmit Kumar joins us now with all the details on this development. Ashmit.
Well, a setback coming in for online real money gaming companies, especially at the hands of the Madras High Court. The Madras High Court, we understand, has rejected the applications of a number of these online real money gaming companies that had challenged these regulations. Now, bear in mind, earlier this year, we had these regulations come out by the Tamil Nadu government. The regulations were quite severe. Number one, it required Aadhaar verification for playing online real money games. That's one. The other was there was a ban in between as a part of those regulations. There was a ban on using these games, on playing these games between 12 midnight and 5 in the morning. Now, it is these set of regulations on time and usage that there was an appeal filed before the Madras High Court. The Madras High Court, however, has dismissed those, and it's used strong language. It's gone on to say that there is a very clear linkage between these online real money gaming companies and these games, as well as with health effects. Given that it affects public health, the Madras High Court then goes on to say this is clearly something that falls within the ambit of a state government. The state government has the necessary power to deal with issues of public health, and therefore it enjoys regulatory oversight, especially when it comes to online real money gaming companies. Further, it went on to say that given as how there is not a complete ban, there should at least be some form of regulation brought into place as far as online real money gaming is concerned. And finally goes on to say that as far as public health is concerned, the state cannot be a mute spectator. It needs to come ahead, it needs to regulate, and thereby defending the stance of the Tamil Nadu government in terms of coming out with these regulations. So, importantly, those regulations on time and usage being upheld by the Madras High Court. But this is an order passed by a division bench of the Madras High Court. So, it's not the final word. The online real money gaming companies have the option of appealing this order before the Supreme Court.
Right, Ashmit, thank you so much for those details. Appreciate you joining us. Moving on, also on what's brewing, fitness and wellness platform FITPASS has hit over 174 crore rupees in annual run rate, is profitable, cash flow positive for over 3 years, and has grown 205% in the last fiscal year, all without a single rupee spent on real estate. Founded in 2015, FITPASS now partners with over 8,000 gyms and studios across Tier 1, Tier 2 and Tier 3 cities, offering everything from AI-led coaching and virtual workouts to doctor consultations and pharmacy benefits. To tell us what's next, as FITPASS sets its sights on the D2C frontier, joining me now is Akshay Verma, the co-founder of FITPASS. Akshay, welcome to Startup Street. FITPASS recently hit over 174 crore rupees in annual run rate and has remained profitable and cash flow positive for over 3 years now. In an industry known for high burn and infrastructure costs, tell us how have you managed capital efficient growth? What has been your approach to financial discipline while scaling?
Yeah, hi, thank you very much for having me here. It's not one or two things that you can identify, but I think two or three things that we always look for as we grow and every next step we take is one, we set out to make consumer the king. Because this was an industry traditionally where the consumer was not the king and he had a lot of restrictions. So our focus on customer satisfaction and putting the customer first, I think, has allowed us to get where we are. Second is our approach that everything that we built has been ab initio and has been from bottom up. So unit economics have been profitable for us since day one. And I think that is what spits out cash as the FITPASS virtuous cycle spits out more demand, more utilization at our gyms. So this at scale seems like big numbers, but it is ultimately at the base level, it is customer satisfaction and positive unit economics from the get-go.
Okay. Akshay, your revenue, like I mentioned earlier, grew 205% year on year in FY25. Now, this is without physical infrastructure. You've got zero real estate investment or aggressive spending. What are the key growth levers driving this kind of scale in such a lean infra-light model?
I think one is this just makes pure business sense. This is what a shared economy model does. And I think a lot of players like Airbnb, Amazon, Uber, all who've operated the shared economy model have proven. So one is just a result of this business model. Second, I think, again, like what I said, that because we put the customers first and because we really value our partners, our gyms, we exist as a layer on top of the gym network. And we have zero attrition in our gym network. So the fact that we've been able to establish deep trust, deep relationships, commercial and personal, with the network is what has allowed us to deliver good customer experience. And that is what has allowed us to retain them. So I think the biggest reason why we've grown so fast is retention. FITPASS members, 78% of them renew, which is exactly the opposite of a traditional gym or a fitness center where 75% people leave their memberships. So they churn out. Because we have flipped the churn and we've inverted the industry, I think that is why you have these numbers that show 205% growth, 174 crore ARR. It is simply putting the consumer first, making them the king and making them feel empowered, which is why they stick with you. When they stick with you, everything looks great.
All right, okay. Now, from personalized AI coaching to doctor consultations and even pharmacy benefits, FITPASS has evolved into a full stack wellness platform. And in fact, you claim to command a 54% market share in the fitness membership space. Akshay, how do you maintain quality and consistency across the 8,000 plus partner gyms that you have?
That's a great question. So actually, we have a 134-point checklist that all our partner centers have to meet. And that is the basic minimum requirement. And that ranges from the size of the asset, the quality of the asset, whether there is parking, whether there are valets, how many ACs they have, what is their current membership prices, what is the education level of the trainers, what certifications they have, what is the education level of the promoters who have promoted the center. So there's a 134-point checklist. And we have a very large network team. It's called the Network Growth and Monetization Team. They are the guys responsible for this network across 130 cities that we currently command.
All right. Let's quickly talk about your recent partnerships, be it Wexer or Noise, and what kind of impact have you made so far, and how are these partnerships really shaping your digital fitness strategy?
So fitness, we have to understand that we live in a country which is the youngest in the world, right? We have the youngest population, average age is 28, 60% of the population is below 35. So digital fitness and partnerships like Wexer, etc., have allowed us to get to 573 cities. Today, FITPASS has consumers, active members in 573 unique cities in the country, which is a tremendous number of cities. So if we did not have these partnerships, we would not be able to cater to the aspirations of the young audience in these cities, because we are not going and building gyms and fitness centers in these cities. But the aspiration to get fit, whether it is driven by personal choices or medical reasons, or because their health is at risk, whatever the reasons for them wanting to get fit, their aspiration was unmet, and we have started to meet them.
All right, Akshay, you're now looking to enter the D2C space and, introduced a new subscription model. If you could elaborate on that transition and what can we expect from this next phase of growth? Also, our global expansion, is global expansion on the radar, or are you planning to deepen your presence in India first?
Okay, this is a great question. But there are two parts. The subscription is separate, the D2C play is separate. The subscription that we've just launched is called FITPASS 360. And that is based simply on the principle that a human being needs both physical fitness as well as good nutrition. So movement and nutrition is medicine for today's young audience and for anybody focused on their health and longevity. So FitPass 360 combines access to workouts, whether it is across the network, home workouts, virtual classes, AI fitness coaching, plus nutrition. And in case you get sick, you also have unlimited doctor consults, health checkups, pharma vouchers. So everything you need to be fit, feel good, and do well is as part of one membership. So it encompasses 360 degrees. This has been fantastic that we launched in Jan. The sales have been fantastic. The subscription in the pilot phase, which is only to a limited audience, 30% of our app users, that gave us more than 3 crore in sales, just the pilot phase. So that is what made us understand that, yes, this is what India needs. People are tired of siloed players trying to solve different problems. And then all the data doesn't make sense to them. How do they keep it? How does it interact? So we saw that. And the D2C play is essentially we have a lot of distribution muscle. We have 8,100 fitness centers and gyms. And we welcomed 4.2 million new members last year.
Yes.
This 2.98 million members that we did the year before. So we have all these people who are looking for solutions from the product side. So we're launching 2 brands. One will be in the smartly engineered fitness equipment space. And one will be in something which will be very uniquely Indian in the nutrition space. And we hope to activate our centers as our points of sale. So suddenly we should be able to give you a couple more 100 crore D2C brands in the next 2 years.
All right. On that note, I'll have to wrap up our conversation, but wish you the very best with your D2C playbook. Thank you so much, Akshay, for joining us on Startup Street today.
Thank you for having me.
Well, in what else is brewing today, PierSight, a Spacetech company building a constellation of satellites for 24/7 all-weather maritime intelligence, has announced that it has secured an additional capital in a seed extension round that brings its total fundraise to $8 million. The new investment comes from Sustainable Ocean Alliance and its venture arm, Seabird Ventures, among others. But for more on the work that the company is doing and the significance of this funding round, joining us now is ex-ISRO scientist and the co-founder and CEO at PierSight, Govt. Gaurav, thanks very much for your time here on CNBC-TV18 today. Let's start with that $8 million funding you've got in total now. What are the top priorities for deployment? And more importantly, what will this partnership with Sustainable Ocean Alliance entail?
First of all, thank you for having me. So the additional funds would be, first of all, used for our products, which are the upcoming satellite, which is set to launch in Q2 of next year, along with our software product, which is called Matsya. Other than that, we've invested a lot in our manpower. Last year, we were able to launch in a record timeline, mainly because of our manpower. So we plan to grow the team by about 30% more. Now coming towards Sustainable Ocean Alliance. So it's an NGO based globally, and most of the ocean companies are a part of it. And their investment in PierSight also shows our focus on sustainability and their acceptance to it. And this partnership with Sustainable Ocean Alliance will open doors for us for collaboration with many other ocean companies in the sector.
All right. Gaurav, tell us about this drone-based SAR program that you've already flight tested. What exactly is this entail? How does it fit in your overall business model? Is it going to be part of a broader integrated intelligence solution from PierSight?
Yeah. So last year we started the drone-based program along with our satellite program in order to de-risk our technology. While we launched a star demo satellite on ISRO's POEM platform, a twin version of the same satellite was put on a drone in order to de-risk our image processing capabilities as well as the signal processing capabilities. So we were very successful in that. And after that, that program has spun out as a separate application altogether. And very soon we'll be coming out with more public release along with one of the partners on this.
All right. But taking that forward, what does the technology roadmap look like for the company? Say in the next 2 to 3 years horizon, you already have the commercial, what you call the SAR plus AIS satellite launch mid next year, the Matsya analytics platform you spoke of recently. Tell us, what exactly do you have lined up?
Yeah, so we plan to launch a constellation of these SAR plus AIS satellites in order to bring persistence to ocean monitoring. So next year, mid of next year, we'll be starting this constellation by launching the first satellite. And in the next 2 to 3 years, we'll be proliferating the constellation. And eventually, we want to build a total of about 32 satellites for ocean monitoring.
Okay, just a broader question with all the illegal fishing, oil spills we've read about recently, maritime insurance fraud, which is on your radar. What use cases do you expect will drive the most commercial value for the company in the near term?
Yeah, few use cases I can directly think of. The first one is oil spill detection. For this, we already have a contract with the Indian Coast Guard and are currently building that solution. Apart from oil spill, the second one is illegal fishing detection. For this particular use case, we have a letter of intent from Global Fishing Watch, which is a large NGO trying to monitor global illegal fishing. Other than that, we can help in port operations. So in this current round, CE Ventures, which owns and operates the port of Sharjah as well as Florida, has also come in and invested, which showcases their agreement to our technology and its potential. Other than that, we are seeing several use cases for the insurance as well as the hedge fund sector.
Okay, insurance and hedge fund sector, that's interesting. But finally, Gaurav, before we wrap up, looking ahead, do you envision PierSight as a satellite operator, as a data analytics company, or something closer to what would be a full stack maritime intelligence platform? What will be the end game for you?
End game will be to have a lot of information arbitrage and maybe become a hedge fund. Just joking. Mainly our vision is to bring all form of surveillance to a control room. We're currently building the satellites because these kind of satellites and sensors don't exist. We're building the Matsya platform specifically for certain Coast Guard use cases because there is no platform which exists like that. And wherever we are finding solutions already existing, we partner with those companies in order to fulfill the ultimate vision of bringing all form of ocean surveillance to a control room. So that is our end game.
Okay, so not a hedge fund. That's not the end game. But Gaurav, finally, if I may just add, because, the kind of technologies you're talking about and the kind of growth plans you have, how long will this $8 million capital that you've got so far last? And how long before you'll have to look for your next fundraise?
So in a satellite constellation building game, essentially, there's long procurement cycle of 12 to 18 months, as well as you need to pre-book the launches. So the current capital would be enough for our first launch, for which, we've booked the launch and done the major expenses. But very soon we'll be, starting our Series A fundraise, which would be further fueling the remaining satellites of the constellation.
All right, Gaurav, we'll leave it at that. Thank you very much. It was a pleasure speaking with you, and thank you for your time here on CNBC-TV18.
Thank you.
With that, it's time for us to head into a short break. But coming up, India's sneaker market is gearing up for a revolution powered by homegrown brands. We put one such brand on the hot seat to uncover what makes them unique and explore their growth story. Stay tuned. Welcome back to Startup Street. 26-year-old Akshay Bhave started his startup Thaely back in 2021. The startup turns plastic trash into new swanky sneakers, helping India solve its pollution problem one shoe at a time. Arundhati Ramanan met the founder to find out more. Take a look.
India's sneaker market is on fire, valued at $250 million and growing double digits annually. But as this market scales, so do concerns about its environmental impact. Traditional sneaker manufacturing is resource heavy and waste generating. Sustainability is no longer a trend, it is a necessity. Conscious consumerism is growing amongst Gen Zs and millennials world over, and this company is catering exactly to that need. Akshay Bhave started Thaely way back in 2021, and these shoes are entirely sustainable. They're made from plastic bags and plastic bottles. Akshay, it's great to have you on the show today. You know, first up, you take like plastic bags, plastic bottles and convert them into cool, swanky sneakers, right? What sort of sparked this idea? I mean, you were just 21. Was it like sort of a personal problem that sort of, you know, made you come up with this idea?
So it started out as a design project. You know, it wasn't really to first find a way to, you know, make shoes. It was first to find a way to recycle plastic bags into, you know, a leather-like fabric that can be used for, you know, some sort of a viable product. And I've always been interested in sneakers. You know, I've been a sneakerhead all my life, and I also studied footwear design. So I thought the best possible application for this new material that I've invented would be shoes, sneakers specifically.
So what would you say has been your biggest challenge while making something sustainable as well as fashion forward?
So surprisingly, you know, when I first started, and I also like raised investment when I was in college, I thought getting the plastic bags itself wouldn't be very difficult, right? Because they're abundant, we see them all the time. You know, they're technically banned in Maharashtra, but we still see them everywhere. So I thought it would be, you know, relatively easy to find these plastic bags. But, you know, that wasn't true. There's nobody that actually collects plastic bags because there's no monetary value attached to them because people can't really recycle them. So we had to work with a waste management plant directly and convince them to collect these plastic bags for us, which are then, you know, recycled by us.
So finding the raw material was your biggest challenge, but also one thing is that sustainability comes at a price, right? Yeah. So how are you pricing your products at Thaely? And if you could sort of tell us, you know, how do you sort of justify the value of your shoes and who are you targeting as your customer?
So our shoes range from 8,000 to 16,000 at the moment. We're launching a shoe very soon that's 3,000 next month actually. You know, initially the issue was volume. You know, we're a small company, so we were of course not producing thousands of shoes every month. So it's a little difficult to get the price down. And also there's a lot more effort involved in making shoes out of recycled or sustainable materials.
So if you could sort of then tell us what kind of demand are you seeing for your shoes at this point? What's the average cart size? And, you know, like take us through your best-selling shoes.
So this one's our best-selling shoe. Our audience is, I would say, typically from Mumbai, Delhi, Gurgaon, you know, the metro cities. It's not very young people, as a lot of people might assume. It's generally people from 25 to all the way up to 40.
Right. Yeah. And then if you can tell me, you know, these shoes, you've told us it's sustainable. Take us through how exactly you make this. How are you sourcing your raw materials? And what is your production capacity at this point? How do you plan to sort of, you know, expand that as you grow your business?
So each shoe on an average is made from 10 plastic bags and 12 plastic bottles. Every part of the shoe is either, you know, recycled or, you know, made from some other sustainable material. For example, the sole is made from recycled rubber. The upper is, you know, this sort of leather-like fabric, which is what we make. You know, that's what we call Thaely. It's made out of waste plastic bags. And then the laces, the lining, you know, this sort of canvas material, That's called rPET. It's made from recycled plastic bottles, which is PET. And even the insole is made from a foam which is derived from the waste that is produced during the the production process of castor bean oil. So yeah, every part of the shoe is thought out. Even the box, it's quite interesting. It's made from recycled paper, of course. It's dyed with waste coffee grounds, and it's also plantable. It's got basil seeds, so yeah, you can plant it.
You sell both online and offline, right? Yeah. In stores like this. So take us through the omni-channel strategy. How much are you selling online? How much is coming, offline? And would you one day want to have your own store with just Thaely products in it? How far in the future is that?
I would say about 70% of our sales are online. The rest are offline. We also have some distributors right now, so we do get this one big order once or twice a year, which does sort of add a lot to our revenue. Apart from that, I would like to open a store sometime next year, hopefully. I do want to sort of build the SKUs. Right now we only have about 14 SKUs, so I don't think we can justify having a store. But yeah, it would be very nice to have a store sometime in the future. What
about the revenues that you're clocking right now? How are your production costs sort of impacting margins? And take us through where you hope to end this year. How do you manage or balance profitability with the purpose?
So revenue, we're doing about 2 crores a year consistently for the last, I would say, 2 years. This year also, I would assume we'll do somewhere similar, but our aim is to be profitable this year. We've already started, not having a lot of cash burn at the start of this year. So, we're not actually burning money. We're still not profitable on like an EBITDA level, but I'm hoping that we'll get there soon, once we have this new mass market product.
So hopefully profitability is just a couple of months away?
Yeah.
Okay, great. Ashay, thank you so much for joining us on Startup Street, and we wish you all the best on this journey going forward.
Thank you for having me.
Okay, moving on, as the US and India deepen cooperation in cutting-edge sectors like AI, quantum computing, and telecom through initiatives like the Trust, questions remain on how the two nations will navigate divergent policies on data governance and digital ethics. To unpack what collaboration could look like from responsible AI to startup innovation, my colleague Aishwarya Anand caught up with Uvika Sharma, the founder and managing partner at Int LDA, on the sidelines of the Select USA Investment Summit in Maryland. Take a look.
Uvika, the first question that I want to understand from you is that US and India have launched initiatives like the Trust, which is to enhance cooperation in AI, quantum computing, and telecommunications. However, differing regulatory approaches, such as India's data localization policies and US's emphasis on cross-border data flows pose challenges. So how can both nations reconcile these differences to foster a more cohesive digital partnership?
We all know that India is very well positioned in terms of tech and the people that are there, the brains that are empowering a lot of other economies around the world. So US has its own set of advantages. They are leaders in terms of infrastructure and technology. So I think it would be best if both parties can come together and harness the benefits, right, that both bring to the table and make sure that innovation actually happens for good.
Given your role in AI strategy and involvement in AI 2030, how do you see the US-India collaborating on certain ethical frameworks for AI and that could help us, bring innovation along with responsible use?
There are a bunch of frameworks that are already available. So, for example, we have the NIST AI risk management framework, and then we also have the EU AI Act, which is a little bit over the top and the next level, but I feel that it is for the right reasons. However, I feel that there could be a balancing act. And I think India can also maybe learn from some of those and see what are the best practices that they can incorporate.
As someone who's been deeply involved in mentoring and supporting diversity in tech, what opportunities do you see for startups in both countries to collaborate, and how can programs be designed to support underrepresented groups in the tech sector?
I